we're finally going to deal with something that we have to deal with every time we sit in front of a client, both an institutional client, or let's say an institutional client, an advisor, or a direct client. And we don't blame them because the world is a scary place, but what are the risks? What are the risks that worry us the most? And what is the chance that we think they're going to happen? So often when I'm asked about risks, I always say, if you know about it, it's probably less risky. The things you don't know about are the ones that really are the most concerning. But if we just start with you, Donovan, what's the risk for us?
So it's not a concern whether AI demand disappears, but I think the more realistic risk that I'm seeing out there is that the market has extrapolated the current rates of capital expenditures, margins, and profitability into the future. And I think with the enormous amounts of capital outlay that the hyperscalers have already done and continue to upgrade kind of at rapid rates that consensus isn't seeing, you get to the more mature next phase of the cycle where a lot of investors now start to question, well, am I getting an adequate return on investment? And we're already starting to see a lot of these hyperscalers getting punished for that. And I think the real risk happens if monetization takes longer than expected. I think if the cost of capital starts going up, because you've seen a lot of these guys raise debt now, not only just using their balance sheet, or even if just the capex put towards AI just slows, not even stops, but slows relative to expectations, I think you could see quite a big move in the market, especially considering how semiconductors have now become almost 20% of the market. And I think in terms of probabilities, I mean, at this, it's very hard to know, but I'd say maybe about a 25-30% probability that you might see some sort of disappointment in the next 12 to 18 months. It's not our base case. We don't assume that like AI isn't a fundamentally good industry, but what we can start to see in the market is that expectations have become quite high and positioning has become quite extreme. And history shows when those kind of things happens, there's always a chance of a pullback. And we already saw that, just a brief little image of that in July, where semiconductors pulled back over 20% in the space of a few weeks. So I think, I mean, when we look at that and we look how the fund is positioned, how it would perform, I think we would outperform in that scenario. I mean, the benchmark is fairly concentrated, the returns, and I think because we have limited exposure to semiconductors, because our valuations are pointing away from it, and we have a lot of exposure to healthcare and fixed income, we should perform well. And yes, we do have 73% equity in the fund, and obviously we're not immune to broad market drawdowns, but we should do a relative outperformance in that scenario.
And just before we dealt with the risk, what is the discount to intrinsic value on our buy list at the moment?
Yes, so the intrinsic value discount on the buy list now is currently sitting at 29%. So remember, we mentioned that the broad market looks expensive, but our bottom-up fundamental, our buy list looks relatively attractive, and I mean that's in context of the long-term history of about 17%. So it's looking attractive relative to history.
So many of the stocks that we own should do 30% plus returns in our view, because there's some that have been completely bombed, but just the kind of average return that's available on the buy list, if everything went to fair value, is about 30%.
Exactly.
So it's a environment where we cannot be out of equities with that kind of return profile.
No, exactly, and that's why we're sitting at about 73%.
Yeah, thanks. Marco, yourself on the domestic side?
Yeah, so I mean, I think over the last, certainly over the last decade, South Africa has become a bit more sensitive to some of the global shocks. And, you know, obviously what's happening at the moment with developing geopolitics and, you know, even some of the fiscal pressures that certain countries are experiencing, you know, my biggest concern is, you know, the transmission mechanism of high inflation environment to local assets. You know, it would lead obviously to higher real rates and potentially lower equity returns. But just from a pure cyclical perspective, it would hurt a lot of the cyclical positions that look very attractive to us. So even though that is not our base case, and we think that the probability of continued high inflation environment is fairly low, it would certainly give us a few headaches, as I mentioned earlier, as being a valuation-driven manager.
South Africa is a cyclical environment, and if it's a cyclical event, if we like it or not, no matter how cheap we are, you know, markets correct even when they're cheap. And it's not that you shouldn't own them over time, but they can have events at any time.
Yeah.
Expensive markets, reprice downwards and cheap markets reprice downwards, and the data shows that clearly over time. Although expensive markets tend to reprice much more downwards than cheap markets do. Yeah, get it. Mark, just in terms of your own views on the greatest threat that we face, and what do you think the chances are of that unfolding?
Yeah, I think in the fixed income space, as Marco mentioned, I think there's policy uncertainty. There are all sorts of geopolitical tensions that are unfolding around the globe. And then also we've seen a change of the head of the Fed, and then they've actually removed guidance. So that's likely to result in potentially higher volatility in fixed income instruments. And so when you're looking at the local market, potential higher inflation for longer, that could push yields up. And then also the concern I have is that we've had some upgrades, S&P and at the latter part of last year, and Fitch in June. So there's a lot of positivity that's embedded in our fixed bonds. But when you look at the spread between our fixed bonds and where US Treasuries are trading, we actually had very, very thin margins. And we're baking those in as fair value gap, which is roughly at about 4.5%. And if you look historically, the long-term average has been 6%. And the only time that we've traded this thinly is literally in the early 2000s, 2004 to 2007 or 8. So, so those are just some of the things that are definitely on the back of my mind when I go to sleep at night.
Makes a lot of sense. Well, I think we've covered, the opportunities, the threats, the positioning of the funds, the performance of the funds. I think we can conclude by saying one thing we know in our business is that we stick religiously to valuation-based work. And we know that if you do that consistently, you win over time. That doesn't mean you don't go through periods where you actually pay quite a price emotionally for not being invested the way the market's being driven at that moment in time. But the corollary to that is if you're always chasing price that's disconnected from valuation, you lose capital, because you can't time, when the music goes off, you're going to be left without a chair. So we all stick to our guns, and we know, because we've done this, as we said, a very long time, that the managers that focus on valuation and spend less time focusing on price are the ones that have the biggest asset bases in South Africa in the year 2026. And most of those guys were around 20 and 30 years ago, each one having experienced the very same phenomena as we're discussing in the markets currently, the dislocations from normalcy, the concerns we have around valuations in certain areas, and the momentum basis at which the market's currently trading.